Hello, and welcome back, guys. Today we're going to be taking a look at Google, which is down almost 3% right now. We will examine what is happening with the company, whether it's a good buy or not as well. Now, this one is very interesting, and it's actually lying where I bought it, or very close to that. I think my cost basis was 118, so basically I'm up there right now. But as you can understand, we're getting more and more information about the latest quarters, so the company's earnings do increase, and so this means that the stock becomes cheaper in comparison to how much they are generating, that is. And this is why, making these videos and kind of refreshing our memories and going through the company's financials again makes a ton of sense, because again, these things change through the years. Now, this one is very interesting because it's one of the tech companies that hasn't been enjoying that much of an explosive growth as others have. For instance, Meta, we have talked about Meta, which at some point was like $80, and right now, actually, let me actually show it to you. So Meta, for example, for which we talked about, and as usual, I'm using our tool here, for which all of our patrons have access to. So if you're interested in becoming one, find a link in the description box below this video and gain full access to the tool. So you will see here that if you take a look at the 3 year chart, for example, for Meta, at some point over here was like $80, how close to that. And then it started going upwards, and you can kind of see it a little bit clearer here at the 1 year chart, like 90 over here, and then take a look at this run. Now, taking it back to Google, you will see that we don't really have the exact same thing. We don't have an explosive growth. So if you take it back 1 year, you will see that we have some growth, but then kind of stalling a little bit and kind of going down. So from 125 over here, now it's actually lower than where it used to be. Obviously, it has gone even lower at some point over here at 90, 91, probably a fantastic buy. But what about right now? Is it still a fantastic buy? Now, if you take it back to like 5 years, you will see that the company overall has been doing very well. And of course, right now it had a little bit of a decline through the pandemic years and kind of trying to get back to where it used to be. So its 1 year high, it's actually minus 10%. So it has lost its value since its 1 year high. But it's understandable because a lot of these tech companies had the same fate pretty much. Now this one, Google, is getting very interesting here because we are looking at a P ratio of 25, which has a very similar price to free cash flow. And you kind of love to see that because you know that the rate at which the company actually converts earnings to free cash flow is about the same. This is why you're getting like an about 25 here. And this is very predictable and very nice to have for a company because it's easy, much easier for investors to predict what the company is going to be doing in the future and actually decide whether it makes sense to buy the stock or not. Now, obviously, the company has been buying back shares because it makes a ton of sense. You'll see them buying more and more because obviously the stock is cheap right now. It has lost quite some value from where it used to be. And, the company making all that money, like Google is making tons of money, it makes a ton of sense to be buying back shares that, they're basically reducing the outstanding shares count here and making it more valuable for investors. Now, I kind of want to take a little bit of a look at the stock news page just to see what's happening here. And you will see that, they are talking about buying the dip, for example, ways to generate yield from the stock and things of that sort. In battle with Microsoft, Google bets on medical AI programs. So AI is going to be all the jazz right now, so you're going to be hearing that a lot. And it's there's sort of like a fight here between Google and Microsoft. Understandable, and has been happening through years. Now, if we go back to the metrics page, this is a company that I really like, and this is why it's part of my portfolio. There are many things to absolutely love for this company. First of all, it's a company that's growing its revenue at a fantastic pace. And remember, this is in the billions. It's already in the billions. And so we're looking at a company that was making like 140 billion back in 2018, and now it's making close to 300 billion. A fantastic increase here. And they have no liabilities, basically, compared to the free cash flow that they generate. And they have net income that keeps increasing, free cash flow that keeps increasing, total equity growth that keeps increasing. And these are exactly the types of companies that I love to hold. These are the companies that are relatively low in terms of their PE ratio and price to free cash flow here, meaning that they are not like super cheap, but they are cheap enough at this moment. And of course, if it gets even lower than that, then it becomes sort of like a given that it's a buy. But we will examine whether this kind of price makes sense right now. Again, we're sitting at 117. Now, you will see that the company's return on equity, return on capital employed, and all that is about 20%. But the interesting thing is the net income margins, which have fallen a little bit. We do know that the profitability in regards to advertising for Google has dropped. That's a known thing. We know that YouTube, for example, earnings have dropped for YouTubers and all that. So we do know that there is a little bit of a, sort of like difficulties there and it's a little bit of a decline. So this is understandable. And this is why we would be a little bit more conservative with our projections there. But still, I mean, the company is generating pretty hefty margins. Like 21% is nothing to sneeze at. And if it goes back to where it was like 30%, that would be even more amazing here. But the company has no debt. Take a look at this one, debt to equity ratio, like zero debt, frankly. And they have so much money. Again, it makes a ton of sense to be looking at the income statement. And I really like to use our 10-year display here in our tool because it takes us back to many years and like 2013, 10 years data, 10-year data here from 60 billion to 282. That's insane increase of revenue. That's what I love to see. And take a look at this one. In between, there hasn't been not even a negative year, not even a slightly negative year. It's always an increase. And like last year was the smallest one, but again, it makes sense because, when you're growing into like almost $1 trillion here, you're not going to be growing at 20% every year. That's just not going to happen, regardless of how good of a company you are. And you will see the earnings per share here, how much it has been increasing. So if you were a shareholder here, you were making $2, now you're making almost $5, which is a tremendous increase. And of course, this is going to be reflected eventually in the stock price. And this is what we're doing when we're buying as investors. We want to catch these when they actually the EPS is low, and then hold it through the years as the EPS grows and grows and grows and grows, along with inflation and the overall economy and everything. Things get more expensive and all that. And so the income of the company should be increasing. They're getting more business, of course. They become a bigger name, for instance. And so once you buy these and hold them for years, you eventually get to reap the benefits, because as the company generates more money, obviously more people are going to want it, the stock price will go up. And the net income, again, 13 billion to 60 billion, again, fantastic here. The balance sheet of the company obviously is super rich as well, with the total equity of the company from 178 billion almost to 256. Now these companies, they could have in some situations lesser equity on purpose because, for instance, they could be buying back tons of shares, and they should, obviously, if they are cheap, of course. And so this happens in some situations, or they could be taking on a lot of debt just to grow. And they do it on purpose. Even though they are making money, they kind of balance the profit that they make with getting extra debt. Basically, it's great for the taxman and pretty much a good opportunity for using money as leverage and having a lot of money to back it up with. And the cash flow statement, you will see here again that the free cash flow from 23 billion to 60 billion, again, pretty much on pace with the net income, and fantastic here overall. Now, the $1 million question, obviously, is the stock evaluator. Our stock evaluator tool will tell us whether the price is right. And so we're going to be using the historical data to actually deduce whether it makes sense to be buying the stock today. With a 5-year average revenue growth of the company being at 21%, which is high, of course. Same with the 3-year average, and last year it was only 10% only. I mean, this is still pretty nice growth for the company. So for the revenue growth that I'm going to be using here, I want to go a little bit lower than 10%, frankly. I want to be a little bit conservative. And I will go 5, 7, and 9 for the revenue growth projections. And the net income margins that I'm going to be using, you will see that they are, generally speaking, about 23 to 24%. So I'm going to go 21 and 22 and 23 here. And the free cash flow margins, again, this is fantastic. What I told you about earlier, it's about 92% here for the 5-year average. 75, 90, 106, 88, 100. That's exactly what you want to be seeing as margins here, as free cash flow margins. And so remember, of course, that this is the free cash flow margin in comparison to the net income margin, right? So if this is 21% and this is like 100%, the free cash flow margin, this means that it's the same. It's 21%. So this is a percentage of the actual net income margin. And so we're going to go with 80, 90, and 100, which I like to use when I'm projecting free cash flow here. And even though the company can be a little bit more lucrative and do a little bit better, I always like to be a little bit on the conservative side. And of course, again, our Patreons can try all their projections on their own just by using the tool and using their own numbers here. It's Really nice actually to be trying all these numbers here, getting answers here from the tool. And we hit calculate, and you will see that with these kinds of projections, which are obviously fairly conservative, we're sitting at a current price of 117 and the high is sitting at 100. With the high again being relatively conservative, not too much, but it's relatively conservative. Now, I have actually bought the stock even at this range, 118, which would probably require some higher revenue growth, like if you go 9, 10, and 11, for instance, maybe we'll get closer to that. We can kind of check that, 107, for instance, here. But that's not really the point. You know, in some situations, obviously, it makes some sense to accumulate stock. And of course, you could be, averaging down, like I bought $5,000 of this one, I believe, when I first bought it. And it makes a ton of sense to be averaging down. But it's not always about being too precise here with the max price to pay, because there are other metrics at play. There are other things at play. And the things that I have talked about, it always makes sense to be buying things a little bit more expensive when you get the chance, than actually completely missing the boat if we're talking about a valuable company that has a lot of things at play. Like for instance here, the fact that they are buying back shares, they have no liabilities, they are a cash machine, their margins are great, no debt. There are so many things to like about this company that, just waiting for $1, if you're playing like $5,000 or $10,000, it may not make too much sense. Now, of course, if you are playing a little bit more money, it makes more sense to be buying at a little bit of a cheaper price. And it's always very, very useful to know a ballpark estimate. This is why a discounted cash flow model gives us an average at about what we are willing to pay. Like somebody could be very hardcore and be like, okay, I'm not really willing to pay more than $100, and actually they would be fine because the company actually reached less than $100 at some point. Like for instance here it was 90. Some other people, may be like, okay, I'm buying a little bit and I'm probably going to average down a little bit later, which is what I've done, for instance, with Alibaba, where I have originally bought, I believe it was 118, no, actually 114, I think, something like that was my cost basis, my initial cost basis, and then I bought again when it was 84, actually. And so, you get a ballpark estimate, you see what the price, where the price is right, and you decide based on your risk tolerance, obviously, and also how good the company is. And this is why it really, really matters to examine all the things about the company. Everything matters here. And so, again, it always makes more sense to buy a company that is great at a little bit of a more expensive price than actually not buying it at all. Like when I bought PayPal, for instance, like let's go back here, PayPal. I bought it at $62, and I made a video about it. Actually, you can find it here in my channel. And when I bought it at 62, there were comments telling me you should wait, like this will probably go down to 50. And I responded with, yeah, it could go down to 50, yeah, in which case I could average down. But why not, let's just grab a little bit, since it's already relatively cheap, and just wait it out and see how this is going to react. And sure enough, this actually went higher. And so right now it's approaching $70. And I could have missed the boat, for instance, if I waited too much on that. So again, you see how it works here. This current cash flow model kind of gives you the ballpark estimate, and then you act on that, depending on again on how risk averse you are or not, and whether there are potentially even better opportunities. But for Google, I could definitely see myself paying like 120, for instance, and be fine with it. Oh, of course, I would obviously love to have paid 100, but again, hindsight is 2020. You don't necessarily know that the company is going to go down that low, for instance. And again, if you're playing like $5,000, you can, for instance, buy a little bit and then average down as it goes down potentially. No need to be buying everything at a certain price. And typically I don't. I actually buy lots. Like for instance, I buy the first lot when the stock price is at a point. Then I buy if it goes down like 10% or 15% more. I buy my second lot, and could be even more depending on what I decide upon the company. But the most important thing, buy quality. And buy quality when it's relatively cheap. But it doesn't really have to be like super, super cheap. If it is super, super cheap, that's even better. But if it's not, and we're talking about a quality company, it's a little bit more expensive, and it makes sense because no debt, fantastic margins, making tons of money, it's going to be growing through the years, then it's still a buy in my eyes. But do let me know, guys, what you think about Google, and whether you're buying right now or whether you bought earlier. Maybe you sold right now, who knows? I'd love to hear your opinion. And I'll see you in the next video. Bye bye for now.